During COVID, the interest rates dropped significantly and everybody took advantage of it. The Bank of Canada and the banks and the government had decided that everybody needs some kind of a relief because people are losing their jobs. To avoid a crash, they lowered the interest rate significantly to help people out. The problem became is that people started to buy houses. So people who already had a lot of money and investors, they're renewing now because a mortgage term, usually the cheapest one is about 5 years. And then the 5-year mark comes up and you're looking at the interest rates and you're panicking because they've more than doubled. The interest rates that we were getting people were at 1%. Now the rates are around 4%. Most people scramble last minute. Oh my God, my mortgage is going to come up for renewal next year. How do I prepare for that right now? A lot of people have personal loans or lines of credit that are secured or unsecured. They are much higher interest now than they were before. Call a mortgage broker, call your bank. See what they say. If you tell me you have some kind of financial situation that your bank cannot solve, I have other options for you.
Helen, good morning. How are you?
Good morning. I'm great. Thank you for having me here.
Thank you so much. I am very happy because you are teaching us many topics that most of the times we cannot understand. And I am worried about that by 2026, most of the Canadians' renewal mortgages are coming this year. So most people are very worried about the increase of the payments because people bought in another condition than now. Mm-hmm. Can you tell us what is happening, please?
Absolutely. So during COVID, the interest rates dropped significantly and everybody took advantage of it. Everybody took advantage of the low interest rates. And the reason why the interest rates were so low is because the Bank of Canada and the banks and the government had decided that everybody needs some kind of a relief because people are losing their jobs. You know, with COVID, everybody was working from home or people weren't working at all. A lot of people got laid off temporarily or permanently. And so people with mortgages, to avoid a crash, they lowered the interest rate significantly to help people out. The problem became is that people started to buy houses. So people who already had a lot of money and investors, and most people who even aren't investors who bought houses 5 years ago and are renewing now, they're renewing now because a mortgage term, usually the cheapest one is about 5 years, right? So you could pick a mortgage term between 6 months to 10 years, generally with the big banks. The most common and the lowest interest rate one is the 5-year term. So you buy a house or you renew your mortgage 5 years ago and then you forget about it for 5 years. And then the 5-year mark comes up, which is 2025, 2026. And you're looking at the interest rates and you're panicking because they've more than doubled, right? They've more than doubled than they were, during COVID time. Let's say the interest rates that we were getting people were at 1%. That's unheard of. No, you're not going to get 1% interest rates, but we did that, right? We were giving people 1.5%, 2% interest rates. And then in 2025, even 2024, people who are renewing in 24, the rates were 5.5%, 6%. 2025, the rates were 4.5% at the end of the year. Now the rates are around 4%, and they're hovering around that at the end of 2025. So if you got an interest rate, if you bought a house or if you renewed your mortgage 5 years ago, your rate was 2%. Now it's 4 to 4.5%. Your payments are doubling, right? You're not paying down that much in your mortgage payments. Most people think, oh, well, I've been paying down the mortgage for 5 years. But in Canada, how a mortgage payment is we amortize it over a period of time. So most commonly, a mortgage is amortized over 25 years. What is amortization? It's the lifespan that you're allowed to carry a mortgage for in Canada. It varies normally between 25 and 30 years, right? So when you're buying a house, even though you're in a 5-year contract, you're amortizing the mortgage saying, I'm going to pay off this loan when 25 to 30 years. So that's what amortization is. And most people don't understand that when you get a loan, especially in Canada, for the first decade or so, 2/3 of the payments actually go towards the interest. And then on the last decade, when you're paying off your mortgage, about the majority of the payments go towards the principal. So let's say you bought a house 5 years ago and you're paying off the mortgage between 5 years ago and now, and let's say you did the minimum down payment needed, which was 5%, you're paying an insurance premium. I've talked in the previous episode about that. So if you want to learn about insurance premiums, go check out the previous episode. You're paying an insurance premium of 4% on a 5% down payment. So you only did 1% down payment realistically, and you're paying most of the payments over the first 5 years on the principal. If your payments are $2,000 a month, about like $1,200 is actually going on interest, and only the tiny portion is going towards the principal amount. So when you come up for a renewal in 5 years, right now in 2025 or 2026, and you're coming up for a renewal on a mortgage, and you have barely touched your principal balance, you started at $500,000, you might be at $490. That is a realistic number because your payments were so small, your interest rate was so small, you didn't double up, you didn't do any extra payments, you just paid the bare minimum. Right now, your payments are going to more than double. That is the reality of what was happening and what has been happening. And you're not only looking at mortgage debt, all interest rates had gone up in the past 2-3 years. You're looking at car loans, credit cards, lines of credit, secured or unsecured lines of credit, home equity loans. Every single interest rate went up. And when you're looking at from COVID perspective, if you had a car loan, it was, around 3%, 4%. Now your car loan's around 6 or 7%, if not more, depending on what your credit is. So basically, all of your payments are doubling now. And so people are scrambling because they don't think about their mortgage for 5 years. Especially if you go to a bank. Your bank is not going to contact you every year. They're not going to reach out to you. They don't care. So what happens is most people scramble last minute and they think, oh my God, I have to find the lowest interest rate. I have to find the best interest rate because if I don't, I'm not going to be able to afford my mortgage. But the reality of it is their bank can very well offer them a very low interest rate just to keep their business. And then what happens is they don't actually look at their overall picture because that person could have a car loan, student loans, line of credit card bills that are a much higher interest rate, and they don't look at the overall picture. They just pick the lowest interest rate to renew their mortgage at because they think that's the best thing because it's their biggest loan, right? But at the end of the day, your mortgage might be $2,000 a month and you might have saved maybe $50 here or there because you went with the lowest interest rate, but you didn't sit down and talk to a professional like a mortgage broker. You didn't sit down, you didn't look at your overall picture. What is your other debt? How much are your monthly payments? What is your cash flow? Those are the big questions that the banks don't care for. They don't give you those answers. You have to sit down with a professional and you have to look at it with them. And really and truly, a good mortgage broker or a good person that you're working with at the bank will contact you and check in on you at least once a year. I have a policy that I contact my clients once a year to check in on them to see how things are going. It's a quick email. It could be a quick phone call. I could say, hey, how are you doing? I have notes from our previous discussions, so I know where you're at in life. I know what's happening with you. Maybe something happened. You had a family member pass away, and all of a sudden you're in debt. You need to talk to somebody about, oh my God, my mortgage is going to come up for renewal next year. How do I prepare for that right now?
If you are finding this helpful, subscribe now to access our complete series of Canadian mortgages and master your home buying process.
So your mortgage is going to be over the span of that 25, 30 years that you take it out for. So the federal government is actually talking about extending the amortization to, 35 years again, which it was a thing over a decade ago. Now, what we're looking at is talking to clients early on. If your mortgage is coming up for renewal in 2026, you really want to start the process 6 months before your renewal. You don't want to scramble last minute. You don't want to leave it to last minute because then you have less options and you're going to stress and panic. Call a mortgage broker, call your bank, see what they say. Your bank might give you a better interest rate than your mortgage broker, but your mortgage broker might say, okay, well, based on this, this, and this, I can actually save you more money because we can consolidate your debt into this, or we could do something else, or we could create cash flow for you. So if you just go somewhere just to get the lowest interest rate, you might not be actually saving any money because, again, most people have other debt. So you're looking at car loans, student loans, you're looking at credit card debt. A lot of people have personal loans or lines of credit that are secured or unsecured. They are much higher interest now than they were before. So those payments could be added into your mortgage, possibly, right? There's a possibility to add that to your mortgage, and that is something that you have to sit down with a professional and talk to them about and lay out a financial plan of what can you afford? Can you afford to do that now? Is there equity in your home to do that? And that's really a big thing that people are not doing right now. People are not looking at the big picture. They're just looking at the lowest interest rate. And unfortunately, if you go with a bank, there's a high chance that the person that you worked with is going to leave because there's a high turnaround. There's a high turnover on people that work at the bank. So somebody you worked with today might not be there next year. And then you're working with a new person. They might not have your notes. They might not know what's going on with your situation. And you're starting all over again. And then that person leaves again. So that kind of happens with the banks because they do have a high turnover of financial advisors and bank tellers. People switch roles all the time. They get promoted. They leave. They go somewhere else. Whereas if you go to a mortgage broker, usually this is our career for life. So this is what we want to do is we want to build our relationship with our clients. We want to keep you with us for that 25-year lifespan. We want to help you, your children, your family, anybody else. And we want you to have financial wealth because if you're financially wealthy, we're financially wealthy as well, right? That's basically how that works. And talking to a mortgage broker is free. Talk to a mortgage broker. It's free. Get a second opinion from your bank.
Thank you, Helen. This topic is very important for me because thinking about the period of the time, the 5 years that you are paying your mortgage and thinking that you are mostly paying only the interest, that strategy sounds amazing. I think that this is a very good idea to think on. However, coming back to the other episode, when you are getting a mortgage, you are subject to be approved and you need to run an application and you need to get approved and get everything done. So at this point, when we need to renew our mortgage, do I have to apply again to get another financing option? Because, for example, if everything is going exactly the same, I will not have any problem. But talking about inflation, the economy in Canada and everything, probably my debt increased. Probably I changed my work and probably my income is lower. So my fear here is that if I get my renewal letter right now and I want to explore another options, on my mind, I think that I will need to apply again. So if I get rejected, what happened in that moment? Is there any safe line to continue my mortgage as it was? Is that possible?
Yeah, so that is a very good question. And the answer to that is a little bit more complicated, right? You can renew with your mortgage with your current bank, and you do not have to requalify if you're just renewing and you're not making any changes. If you have loss of income and you have more debt accumulated, you should still talk to a mortgage broker and see what your options are. It's not going to affect you if you have to renew with your bank. Those are two separate things. You're getting a second opinion from a mortgage broker. You can talk to your bank. But I would say if you're in that situation, talk to a mortgage broker first. Don't talk to your bank because, again, it's biased because I am a mortgage broker. But the reason for that is if you tell me you have some kind of financial situation that your bank cannot solve, I have other options for you. It might be other lenders. I might even say you are in a really bad place. You need to go through debt consolidation. I know somebody who can help you with that conversation and take you through those options as well. And again, it's free to talk to that person. So it opens you up to other options. Because if you are in a bad financial situation and you want to just renew your mortgage without re-qualifying, you can do that with your bank. But what is that going to do for you? Because the interest rates are still high. That's not actually helping you. That's just putting a Band-Aid or just progressing towards a bad place. You're progressing towards furthering your bad debt. You don't want to do that. You want to fix your situation right away as soon as possible. Obviously, the sooner the better, because with debt, the longer you prolong it, the worse that it gets, because again, you're just paying interest and interest and interest, and you're losing money. You don't actually have any money going into your personal pocket. You're just paying off interest on somebody else's loan.
Okay, thank you so much. And what is the best period of time, the golden window to make this assessment again before renewing your mortgages?
If you are a homeowner and you're struggling financially, anytime, call a mortgage broker anytime. You don't have to wait for your renewal, because you can renew your mortgage anytime, or you could what we call refinance, which we'll get into that in the next episode. But refinancing is basically using the equity in your home to consolidate all of your other debt. And that is a really strong tool that you have as a homeowner, because a home is an asset. And with an asset that you're taking care of and it's in decent shape, and even with the current market, even with some places that are losing equity like Toronto or Vancouver, Halifax still has a very strong real estate market. Nova Scotia still has a very strong real estate market. And so you are still building equity in your real estate here. And it's a very strong tool to take advantage of that right now and see how you can consolidate your debt with that. So we could talk about that in the next episode about refinancing, because that is a really big topic that people don't know about, don't take advantage of enough. And there's some do's and don'ts that I will talk about as well.
It will be very interesting, Helen. Thank you so much and hope to see you soon.
Thank you so much. Thank you for having me.
The renewal shock is real, but your lender's first offer isn't your only option. In the next video, we are exposing why being lazy with your renewal letter could cost you $5,000 and how a mortgage switch changed the game. Don't leave money on the table. Watch the next one now.